Investing mistakes we wish we avoided when we started. Trading some stocks is one thing, having sustained long-term success with your investments is quite another. As a first-timer, we made many mistakes that led to a close downfall, so now we're here to prevent you from making those same mistakes. Achieving your investment objectives can have a significant impact on your financial well-being, result in financial independence, enable early retirement, and possibly even make you quite wealthy. On the other side, making repeated financial errors can drastically reduce your quality of life and your capacity to accumulate retirement savings. Here are 7 classic investment errors that novices and even seasoned investors frequently make. To position yourself for financial success, make sure to stay away from these investing mistakes. The first investing error, failing to have a strategy. A professional sports team will always have a game plan before a big game. Similar to this, you should create a long-term financial plan before you begin investing. Always begin with a savings plan while you're investing. Your investment objectives and the timeline for achieving them should be described in your savings plan. You should decide your investment risk tolerance so that you can stay on track while making some return estimates so that you know how much to save. As with any good plan, it's crucial to check in on them from time to time to gauge your success and make any required revisions. The worst enemy of an investor is often human emotion. Even seasoned specialists can become confused by the emotional highs and lows of investing. If your investment plan is not based on a strong basis, it can result in more errors and losses. By establishing a plan and following it, you can eliminate guessing from investing, allowing you to rest easy even when circumstances change or the market turns. 2. Second investment blunder, attempting to time the market. The fact that financial markets operate in cycles is one of their best-known traits. They ascend before descending. We can learn from history that there are both very long cycles and short-term corrections. Given the information available to investors, the supply and demand of the market determine value. As a result, the market value of tomorrow will be determined by the knowledge that is only going to be available tomorrow. Investors fluctuate between pessimism and optimism. Their optimism or pessimism can skew their perception, making people assume they already know what will happen tomorrow. One of the most frequent errors investors make is trying to time the market by selling to purchase back later or taking significant risks in the hopes of eventually reselling at a higher price. Even worse, some investors could be right once and mistake luck for wisdom, which causes them to repeatedly make worse blunders. Timing the market successfully is a pipe dream, yet many investors, from beginners to experienced traders, fall victim to it. More than 66% of beginning traders attempt to time the market occasionally, and 20% attempt to do it frequently, according to an Investopedia survey. In actuality, investors who attempt to time the market run a higher chance of losing money. Here's one instance. If an investor missed the best 5 days of the S&P 500's returns in the previous 20 years before December 31st, 2019, his return would have been only 5.62%, or nearly half that of a passive investor. Even worse, the investor's return would have been negative if he had missed the top 20 days, or 1 day a year. You want to take a long view when it comes to the markets. According to a quote from Warren Buffett, if you're not willing to hold a stock for 10 years, you shouldn't hold it at all. Investing mistake 3, using intuition as an advisor. People are emotional beings. We are created to interpret and fuel our interpersonal and societal reactions using our emotions and instincts. However, when making investments, it's best to avoid relying on emotion and instead use data and facts. Indeed, a lot of poor financial decisions are the result of emotional factors. Anxiety and dread can cause people to want to time the market or sell a good investment after it has demonstrated strong performance for a brief period. Greed and FOMO can lead to irrational speculation on good investments. Your gut feeling, or sixth sense, is a poor guide. A seller and buyer are always on opposite sides of any transaction. For what reason is the stock you want to acquire being sold by the other investor? Does he have more knowledge than you do? Is his choice supported by evidence? Consider a trade as a conflict over money. Who will triumph in this conflict and succeed? The person who has access to all financial information, or the person with a nice feeling? Investing mistake 4, lack of diversification. One of the investing deadly sins is a lack of diversification in one's portfolio. Poor diversification raises instability and can lead to dead loss, which is the biggest enemy of an investor. Even worse, the market pays little for the concentration risk that emerges from a lack of diversification. For instance, it would have been wiser to hold a portfolio of stocks from companies like Samsung, Apple, BlackBerry, and Nokia in equal amounts 15 years ago if you wanted to wager on the development of the smartphone, rather than place all of your chips on BlackBerry or Nokia, which were still acknowledged as the market leaders in cell phones at the time. Or suppose a trader wished to wager on the rise in the value of U.S. bank stocks, which plummeted in 2008 at the height of the financial crisis. In contrast to an investor who staked everything on Washington Mutual, which regrettably went bankrupt, the outcome would have been great if they had gambled on a portfolio of American banks in an exchange-traded fund. Diversification gaps can be sneaky. It frequently occurs when employees of publicly traded corporations own stock in their employer, as well as shares in their pension fund, as well as stock options. Many former Nortel workers were millionaires at one point in history. Therefore, to maintain perspective, ensure that your portfolio is sufficiently diversified and that you always think of it in percentages rather than dollars. Investing mistake 5. Gambling instead of investing. The distinction between betting and investing might be hazy. When managing a portfolio, you place bets on particular securities and circumstances. However, two things make investing and speculating significantly different. The first is risk management, which is crucial for successful investing. As a result, failing to diversify is a serious mistake because it increases the likelihood of suffering a substantial loss. Second, bets are made by assessing the advantages and disadvantages, which are supported by facts and statistics. When the data is calculated, we can place our wager and consider the advantages and disadvantages in light of all the available information. Unfortunately, rather than investing in a strong company for the long term, many investors prefer to wager on short-term price changes, or they take a chance on a brand new, intriguing technology rather than investing in technology businesses with strong sales, profits, and cash flow. These strategies may be thrilling, but they're not the most effective long-term means of increasing your money. The best investments that are profitable are, well, boring. Investing is a race that is best won by slow and steady 9 times out of 10. Investing mistake 6. Chasing returns. Many investors choose their investments based on recent results. Utilizing performance-based star systems to categorize mutual funds is a very common practice. Unfortunately, a strategy is probably overdue for a return to normal after excelling for a few years. When you try to invest in funds or methods whose value has increased, you end up selling at a loss. This is an excellent tactic to guarantee you to receive minimal profits. Consider Bitcoin as an example. Cryptocurrencies are in high demand, but most experts advise caution since they might simply be another example of an asset bubble that is due to explode. But in investors' minds, the dread of missing out on this breathtaking growth and those inflated historical profits is a force that's difficult to overcome. Investing mistake 7. Using the wrong information sources. Your information's accuracy is always based on its source. Financial misinformation arises because dishonest individuals profit by attempting to drive up the price of particular stocks to the seller's advantage. Unfortunate but all too common examples include the numerous pyramid schemes that have soiled the history of finance over the years. Financial letters and gurus have emerged as a cottage industry since finance is influenced by future events that are unknown at this time. Their goal is to attract investors' attention by preying on their fear and greed to make as much money as possible. Furthermore, there's frequently an information gap between the selling party and the buying party in a financial transaction, even when there is no wrongdoing. Being among individuals with inaccurate or inadequate information is another error that might have detrimental effects. Don't worry if you recognize yourself in that last line. Having inaccurate or insufficient information is highly common because human behavioral patterns are what lead to these mistakes. Fortunately, there is a simple way to guarantee that you get the most accurate information available so you can make wise financial decisions. A knowledgeable, independent financial advisor can be a valuable ally to help you avoid these typical problems, reduce costly errors, and increase your chances of financial success. This ends the mistakes we wish we had avoided at the start. Hopefully, you'll be able to do better. Like, share, and subscribe to the channel to learn more.